Welcome to this week's episode of Accredited Investor Markets Radio. Each week, we speak with you about investing in alternative assets. Unbiased and beholden to no one, Accredited Investor Markets Radio does not accept advertising from any investment firm or financial advisor. Accredited Investor Markets Radio is the spoken word sister of AccreditedInvestorMarkets.com, the internet's most comprehensive and unbiased educational resource about crowdfunding, angel investing, venture capital, private equity, private shares, and other investment classes beyond publicly traded stocks and bonds.
Hello and welcome to Accredited Investor Markets Radio. I am Christopher Cahill. In a few, we'll be speaking with David Freedman. David Freedman is a veteran financial journalist. He's been doing it since 1978. That's 37 years. Most recently, co-author of Equity Crowdfunding for Investors, published in 2015 by John Wiley and Sons. But first, let's look back a little bit in our own history as Accredited Investor Markets Radio. In episode 13, and that was over a year ago, we had Jerry Mills on the program. Jerry Mills is the founder of B2B CFO, Business to Business Chief Financial Officer. And he was on the show speaking of the baby boomer tsunami. That is, the departure of many businesses owned by baby boomers from the hands of those baby boomers. And in connection with this tsunami, which is really an opportunity for those who wish to buy businesses and those who serve the industry of buying and selling businesses, Mr. Mills wrote the Exit Strategy Handbook, published in 2013. His business, B2B CFO, provides a digital dashboard component to help business owners track the progress of their preparations for sale. It was interesting stuff. Well, there was an article written in the Wall Street Journal, October 14, 2015, by Ruth Simon, entitled, "The Missing Boom in Small Business Sales. Baby boomers aren't letting go." Quote, "Despite predictions that a flood of small businesses would be coming up for sale as owners of a certain generation ready themselves for retirement, many are holding on longer than expected. According to a U.S. Census Bureau count of owners of incorporated firms, people aged 55 and older accounted for 38% of business owners in 2013, up from 29% in 2005. Sales of small firms are on a pace to drop 3% this year, after increasing in 2014 to their highest level since at least 2007, according to BizBuySell.com, an online marketplace for buying and selling small companies. Brokers reported 1,814 businesses changing hands in the third quarter, down 5% from the previous quarter and 9% from a year earlier. Well, so it's happening, but not as quickly as people thought. And there's an example in the article of why that might be. Some business owners that struggled during the recession now see new opportunities in the recovery. Robert Sharman, 59, co-owner of Rowe Fenestration, Inc. I love the name of that company, Rowe Fenestration, Inc., a consulting firm and supplier of materials used in commercial construction, says his 10-year-old firm used the downturn to hire high-quality workers, even though sales were slow. With construction picking up, his plan is to double revenue every 3 years over a 12-year period before selling the company. So, out with the old and in with the new, but that'll happen when the baby boomers are good and ready to do so. Which reminds me of a song near and dear to baby boomers. We talked about Blood, Sweat, and Tears, the jazz rock group, a few weeks ago. They had another song besides Spinning Wheel, which we talked about in connection with Fortuna then. And this is called I Love You More Than You'll Ever Know. And I think this applies precisely the developments described in Ms. Simon's article. This is the business owner speaking. When I wasn't making much money, you know where my paycheck went. I brought it home to baby. I never spent 1 red cent. Is that any way for a man to carry on? Do you think I want my loved one gone? I love you, baby, more than you'll ever know. More than you'll ever know. Of course they're hanging on. They're not going to let go of that. Well, let's move on. Let's move on to blockchain and other things like that. Blockchain. It's really just a certain kind of ledger, but it sounds like a pro wrestler. Blockchain. Well, the really superb database known as dealindex.com had some comments about investment in the Asia-Pacific region. Now, remember, we had Neha Manaktala, the creator of dealindex.com, its founder, on this program a few weeks ago. And what dealindex.com does is aggregate financial data worldwide with regard to private company transactions. So this is an article in the Deal Index blog about Asia-Pacific financial technology startups. Asia-Pacific fintech startups experience tremendous growth in investments, dated November 10, 2015 by Michelle Tang. And in their commitment to providing data, such articles in the blog always refer to their sources. So Accenture is the source for the following data. Fintech investment in Asia Pacific has skyrocketed in 2015 from about US $880 million in all of 2014 to US $3.5 billion in the first 9 months of 2015. Leading the charge with regard to fintech again is lending and payments, with blockchain, the cloud, and cybersecurity coming next. And as regards interest in cryptocurrency and blockchain technology startups, the article reports that globally, US $461 million has been invested in 54 companies during the first 9 months of 2015, according to CoinDesk. And as regards cybersecurity, an interest of this program since its inception, really. It was about a year ago that we suggested musically that mamas should not let their babies grow up to be cowboys. Don't let them pick guitars, draw down their savings, let them be cybersecurity mavens. Well, according to CB Insights, as reported in this Deal Index blog entry, global investment in cybersecurity companies hit US $2.4 billion in 2014, up 40% from 2013. The dollars are following the changes in our world, the changes in our businesses, and the state of play in which business is conducted. And now something exciting from Bloomberg Business, November 20th, 2015. Inside the money laundering scheme that Citi overlooked for years, Citigroup's Banamex USA unit turned a blind eye on the Mexican border by AIMkts and Dakin Campbell. First paragraph and a half or so. When Antonio Peña Arguelles opened an account in 2005 at Citigroup's Banamex USA, the Know Your Customer document said he had a small business breeding cattle and white-tailed deer, ranch-raised, for their stately antlers. About $50 a month would come into the account, according to the documents. A week later, Peña Arguelles wired in $7.09 million from an account in Mexico, allegedly drug money from Los Zetas, a violent cartel founded by former Mexican soldiers. Documents in his money laundering case in Texas say, in all, Peña Arguelles shuttled $59.4 million through the account, according to a confidential report by banking regulators that berated Banamex USA in 2013 for failure to comply with anti-money laundering rules. And the article includes a photograph from 2011, which shows the body of Alfonso Peña Arguelles, the brother of Antonio Arguelles, who is the account holder, who had been murdered in 2011, and his body was dumped at the Christopher Columbus Monument in Nuevo Laredo, Mexico, under a banner which expressly called his brother Antonio, quote, a money laundering murderer living in the U.S. And Banamex did zero about the huge amounts of money going through this deer antler account, or about this rather famous and infamous murder of the brother, which identified the account holder as a money launderer. Reports were filed. The FDIC, the California Agency for Bank Supervision, all got involved. And there was a prosecution of Antonio. So Citigroup had to answer for all this. Mark Costilio, a spokesman for Citigroup in New York, said in an email that Banamex USA has made a, quote, comprehensive effort over a number of years, end quote, to address regulators' concerns, including enhancing controls and ending certain customer relationships. I'll tell you, it's statements like that make people despise suits. A little more from Mr. Costilio, the Citigroup spokesman. He declined to comment on specific allegations made in the FDIC report and by former employees. More broadly, he defended the bank's efforts. Quote, Citi is committed to achieving the strongest possible system for anti-money laundering and sanctions compliance, end quote. We fully understand our obligation to be vigilant and respond to the changing patterns of criminal and terrorist behavior. Over the past several years, we have spent nearly $1 billion annually and now employ more than 11,000 full-time employees to prevent money laundering. So according to Costilio, Citi is committed to achieving the strongest possible system and that they fully understand their obligations. Boy, if I haven't heard many dozens of bureaucrats speak in that way, and to defend their programs on the basis of how much money they spend rather than the results, or identifying any metric for measuring the results achieved. Well, the end of the story is that the FDIC fined Banamex USA, or I should say a subsidiary of Citigroup, $140 million in July 2015 for violating anti-money laundering laws. And Banamex USA's remaining branches are closed and the entire business is being wound down. Well, after that example of financial reporting, let's talk to a financial reporter. We have with us today David M. Freedman. David Freedman, a financial and legal journalist since 1978, has served on the editorial staffs of business, trade, professional journals, and most recently as senior editor of The Value Examiner, which is published by the National Association of Certified Valuators and Analysts. We're happy to say at Accredited Investor Markets that we have had the benefit of David's fine journalism for the last couple of years. He has many very valuable articles there. Well, Dave has also written extensively about real estate, economics, social media, and woodworking, which was the subject of a book of his published in 1997. One wonders at the commonality among those various topics, and I guess its structure and function. Dave is also co-author of Equity Crowdfunding for Investors, which was published this year by John Wiley & Sons. Equity Crowdfunding for Investors is a concise and cogent guide. Dave, thank you for joining with us today.
You're welcome. Thanks, Chris. I appreciate the opportunity.
Dave, you've been a financial and legal journalist for 38 years. It was only a few years ago that you started writing about private securities, and particularly about hedge funds and angel investing. Well, what attracted your curiosity so that you would start writing about this as a journalist?
I read Michael Lewis's book, The Big Short. It was about a couple of hedge funds that made spectacular profits by anticipating the collapse of the mortgage-backed securities industry. And it was just such a fascinating book and really wild. I mean, it was like the Wild West, of investments. And I became really interested in hedge funds, so I started reading more books about them, especially the short sellers like David Einhorn and Bill Ackman. And so I started writing about hedge funds as a journalist, and that was the first time I'd ever covered private securities. And then the Jobs Act of 2012 opened up the private securities markets to masses of new angel investors. First, Title II of the Jobs Act lifted the ban on general solicitation for certain Regulation D offerings, and that led to, according to data I've seen recently, a 50% increase in the number of accredited investors participating in private securities offerings. So the field of angel investing is growing and becoming more, and investors are becoming more aware of it as general solicitation is being utilized.
So the field is growing, but isn't it still a fact that the field of people who participate as accredited investors under Title II is very much a small subset of the potential field? That is, the kinds of people who are the numbers of people who would qualify as accredited investors by income or wealth.
In other words, Title II offerings, which use general solicitation, is only a small subset of all Regulation D offerings.
Well, what I mean is that that you've talked about larger numbers of people are taking advantage of Title II, but many times that amount could, but don't, is what I'm trying to say.
I see. Yeah. There might be 8 or 9 million accredited investors in the United States, and only 1 million or so are participating, or now maybe 1.5 million are participating. We expect that as more companies realize the benefits of general solicitation, there will be more awareness in the marketplace. Also, as I think more investors realize the need to diversify away from public securities and into alternative assets, which are not correlated with the general market, I think they will make themselves more aware of opportunities to invest in private securities, and especially Regulation D offerings and angel investment deals and crowdfunding.
Well, then, so that's Title II, which has been called crowdfunding, but Title III is another title of the Jobs Act. We're going to talk about 3 different titles of the Jobs Act, and I want to keep these things straight for our listeners. So Title III has some recent history, and that's for real crowdfunding, even though Title II is sometimes called crowdfunding, but Title III is for real crowdfunding. What's been happening there?
Yeah, Title III is really for the crowd of all investors, including non-accredited investors who have largely been shut out of the private securities markets for about 80 years, since the Securities Act of 1933. So we know that, a couple of weeks ago, the SEC issued final rules under Title III of the Jobs Act, which will allow equity crowdfunding for non-accredited investors starting in April of 2016. This is the mechanism for seed stage startups and early stage companies to go to the market and raise money up to $1 million per year, whereas the other securities exemptions that have been used most recently as crowdfunding offerings have attracted either only accredited investors or investors who are interested in larger, later stage companies. So Title III is going to really do 2 things. It's going to open up the market to more investors, tens of millions more investors, and open up the markets to more earlier stage companies who want to raise capital.
I should mention in connection with this that there have been dozens and dozens of articles that were spurred by the approval of the SEC rules for Title III. You wrote one that was published on AIMkts, or AccreditedInvestorMarkets.com, which covers the field, I think, very, very well. So if somebody needs a précis on Title III, please go to AIMkts.com and look for David Freedman, and you'll find the article. I understand that Mary Jo White, the SEC chair, has suggested that the Jobs Act could, quote, spur a period of transformative change in capital formation. Maybe that was something that attracted your interest as a journalist as well.
Oh, absolutely. By kind of deregulating the private capital markets to some extent, you're going to see a lot of, a surging supply and a surging demand for these kinds of offerings. More entrepreneurs will realize that there are ways to raise capital that doesn't cost, an arm and a leg, because they don't have to file registrations and get audited financial statements. And also investors are going to realize that they don't have to have $50,000 or $100,000 to invest in a startup. They can do it with less than $1,000 maybe, or even a few hundred via equity crowdfunding. It's going to create a surging supply and surging demand for these offerings, and that will result in a growing market. And also some innovations that we probably can't anticipate yet, but I can kind of predict that there will be new internet technologies that make it more efficient to connect issuers and investors. One example of an innovation would be new internet technology that more efficiently connects issuers and investors to more investors, and more investors, facilitates more collaboration between investors when they're doing, for example, due diligence, research into founders of startups, deal sourcing. This is crowdfunding is a very social activity, and there's going to be a lot of collaboration, investors. Another kind of innovation we should see in the next few years will be simplified deal terms that unsophisticated investors can understand, because they're going to demand it. Some term sheets are just impossible to understand without paying a lot of money to have a lawyer explain it to you. And it's going to, if that's the only way they can invest, it's going to suppress that demand.
Yeah, that's interesting. I mean, because we're talking about not just technical innovation, but legal innovation.
Exactly.
So there's an opportunity there for scalable legal innovation that I'm sure somebody's seizing. I should mention that in an earlier program, I interviewed Marty Coyne of Connected Investor, and the focus of the interview was the technical innovations of internet platforms under Title II, which we can expect. Lots of people rushing into that space. Connected Investor is a real estate platform, and he estimated somewhere between 150 and 200 functioning internet real estate investment platforms, and I'm sure the number has gone up since then. There's a lot of talent being brought to bear on these problems I'm trying to suggest.
Right, a lot of talent, a lot of innovation. They're going to push boundaries. They're going to push, legal boundaries, technological boundaries, social boundaries. People are going to be talking about what they're investing in online.
Well, it's music to this lawyer's ears. My day job. All right. Well, repeating once again, I hope not too often, that you are the co-author of Equity Crowdfunding for Investors, published this year. Chapter 3 of the book, which is not a long book, it's a short book, and thereby still more useful. But Chapter 3 of it summarizes the proposed rules the SEC was going to issue under Title III at the time you finished writing the book. Well, the SEC issued final rules, and did that throw a wrench into your summary? Are you going to have to revise the book or publish a new edition?
Yeah, I'm glad you asked that. Thank you, Chris. Of course, there are a few minor rules that we didn't anticipate. We tried to point out in our book that there would be changes in the from the proposed rules to the final rules, and we pointed out areas where the changes might take place and what we expected the changes might be. And in most cases, we were accurate, but there were a couple of things we didn't anticipate, such as the ability of crowdfunding portals to buy equity in the offerings that they list on their sites. We didn't expect that the SEC would free the issuers from having to get audited financial statements, which is for first-time issuers only, by the way.
Big deal.
Yeah, right. So there will be a few tweaks we'll have to make in the next edition of the book. We're probably going to put out a supplement meanwhile that, updates Title III rules, Title IV, news about Title IV offerings, because the book was published before Title IV became effective.
Yeah, there's Titles 2, 3, and 4. And maybe you were about to say this. There's also the issue of intrastate securities exemption. So our challenge in the next few minutes is to, again, just delineate between 2, 3, and 4 and to discuss what role states have in all of this. So if 2 is accredited investors, 3 is the general crowd, new rules for each of those, more liberal rules, well, then what's 4? Title 4 of the Jobs Act.
Sure. Title 4 became effective in June, and what it did was it took the moribund Regulation A exemption and expanded that from $5 million maximum raise to $50 million. It also, for raises above $20 million, it preempts blue sky review. So there's no need to get approval from every state in which the offering is made.
This is all about avoiding the onerous, at least for those who have to do it, the onerous registration requirements that public securities have to undergo. So there are deals of up to 20 and then 20 to 50, and then there are state laws, and Title IV makes it easier to do these deals without registration. Is that basically the bottom line?
Well, I wouldn't say exactly without registration. It's a kind of a scaled down registration process.
Yes.
And the issuers have to file a prospectus-like document called an offering circular with the SEC, but it is a lot simpler and a lot less expensive than filing a real full prospectus and going public. This is being called the mini IPO. It's mainly for later stage growing companies that are not quite ready to go public.
And it's mainly for later stage.
Yeah, okay. So it's mainly for later stage companies. I don't think very many, seed stage startups are going to participate in this, Regulation A plus offerings.
One thing that people don't always appreciate is that there are state securities laws. And I guess Title IV does provide a relief from having to comply with each state in which you do business or each state in which you're issuing securities. Is that what we're talking about?
That's true for raises above $20 million to $50 million, which is called Tier 2 of Title IV. That preempts blue sky review. So it saves, a heck of a lot of money having to be reviewed by a number of states. Also, what some people might not realize is that Title IV, it's based on the old Regulation A, which always did allow non-accredited investors to participate. And it just wasn't used very much. And the new Regulation A Plus also allows non-accredited as well as accredited investors to participate, but there are investment limits based on their net worth and income.
Okay, well, it's kind of a new world.
It is.
And this is just over the last 3-4 years.
That's right.
Yeah, but you've been doing this for 38 years, Mr. Freedman. So, anytime you're doing anything for 38 years, there are surprises. And I'm going to ask you a personal question. Over your 38 years of reporting, what strong presuppositions about the U.S. financial system that you were holding, that you held dear, on which you based your understanding, what presuppositions could you identify that you had to abandon under the weight of fact? Well,
I'm glad we discussed this question earlier, and I have to disclose that I've thought about it. And I think when I was younger, I had this illusion that free market capitalism, which I wholly subscribe to, is a system where everyone succeeds or fails based on merit, based on how hard they work, based on their innovative ideas, if you invest in a stock that is reliably profitable, you'll get a good return on investment. That's kind of like saying the justice system is always fair. That was my early illusion, and I came to the realization that the system is rigged by politicians. Capital markets are rigged by the people with the most capital. The marketplace is rigged based on affinity, which is another way of saying bias and prejudice. And it's still, the best system, but it just wasn't as simple as I used to think it was.
When you say rigged, is this the inevitable result of human beings interacting in a rules-based system where the rules can be changed by political pressure or by gaining influence within the regulatory bodies? Or do you see it as a more aggressive sort of rigging by private groups simply taking advantage of others?
Can I say both? Yeah. We're primates, and primates are hierarchical. The dominant members of the species pretty much make the rules and change the rules whenever they want. So I think, and that's one of the reasons I thought communism would never work, or it wouldn't be sustainable, because when everyone is a member of one class, the illusion of communism is that when everyone is a member of a single class, they'll cooperate.
Yeah.
And do what's best for for everybody. But we're primates, and we're hierarchical, and that's why I say communism is based on an illusion. But so is capitalism. So is free market capitalism. There's this illusion that there's equal opportunity for everybody, and we try to make that happen. We do our best to make that happen, but it just it will never be perfectly equal, or even close.
Well, I'm going to exercise my simian rights here to end this interview.
It looks like you're in the dominant position at this point.
That's right. And so, because we've basically run out of time. But Dave Freedman, veteran financial journalist, reliable and highly valued contributor to AIMkts.com, and author of a more or less definitive short book called Equity Crowdfunding for Investors to provide insights into the Jobs Act. Thanks again for joining with us.
I appreciate it. Thanks a lot, Chris.
And thank you all for listening. This has been Accredited Investor Markets Radio. Accredited Investor Markets Radio is produced by Stephanie Strait. Let's do this again sometime soon.
Thank you for joining us. If you enjoyed this episode, you can subscribe through iTunes or Stitcher, or you can download our app from Libsyn. You can also listen right on our website, www.aimkts.com. Each week, Accredited Investor Markets Radio brings you news and education about investing with a focus on alternative assets. To see a short written summary of this episode, go to www.aimkts.com. Accredited Investor Markets Radio is a production of Financial Poise Radio Productions, LLC.